Good morning, Gabe. I was looking at investing in a mutual fund for my Roth IRA. Some have investment plans that emphasize growth and others emphasize income. Which way should I go?
Rick, it's great you're looking at the best plan for a mutual fund, Roth IRA. Each type of fund you describe has a different focus based on your overall life goals.
My overall life goal is to be comfortable in my older years. I know investing now is a good way to get there.
Yes, I agree. A financial advisor can best discuss your specific life situation and devise a comprehensive investment plan. There are fundamental differences between growth investments and income investments. For the more do-it-yourself investor, I think I can give you a simple rule to help you focus as you start out. Welcome back, YouTube community. Gabe here. Last time, we talked about taxable effects of unemployment compensation and stimulus payments. Today, let's discuss your YouTube business and the difference between growth investments and income investments. Depending on your age and retirement goals, one could be much better for you. Our discussion will include examples that are not specific recommendations. Shall we begin? Rick, you're a professional musician. Are you still performing?
Not as much as I used to, Gabe. 2020 was not the best year for being on the road performing. I was able to get a few marketing gigs, creating radio jingles for some of my main clients. I still post some of my performances on my YouTube channel.
I see. As young as you are, it's good that you are looking at a Roth IRA. There are some important differences between a growth fund and an income fund. Let's jump in and consider each. The primary focus of investing is to accumulate capital assets. Capital assets are things you own that generate money. A personal home that you own is a wonderful investment. However, it is a consumable asset. The primary purpose of owning your home is to build equity, not generate money. A capital asset is something that will generate money and build wealth. Capital assets can include physical items, like land and buildings, as well as intangible assets, like patents and royalty rights. Acquisition costs can be a barrier to the accumulation of capital assets for many people. One category of asset that has a low acquisition cost, is easily transferable, has the potential to generate income, and can be a tool to build wealth, are stocks and mutual funds. Let us suggest that the ultimate goal of investing is building wealth. The path to wealth is the accumulation of capital assets that generate income. Does that mean we should focus on income-producing investments?
That makes sense to me.
Good. I'm glad you're tracking. Now let's dig deeper. Investing in capital assets involves two separate but complementary considerations. 1. Risk tolerance, and 2. Time horizon. In considering time horizon, the issue is, when will you need to access the money you invested? In considering risk tolerance, the issue is, what are you willing to lose as you use your excess investable funds in order to accumulate capital assets? Anytime you invest money, you run the risk of losing your entire investment. That is why investing in something that allows you to measure the probability of loss over time is so important. Growth stocks can be more volatile than income stocks. However, by the nature of the stock, they have a greater potential to grow over time. The prices of such stocks tend to fluctuate greatly, as a result of external economic factors. The concern is, whether a dip in price takes place, just as you need your invested funds, or want to rotate your investments. And, how long it will take for the price to recover. Small capitalization, or startup company stocks, tend to reinvest their profits back into the company instead of paying dividends. The goal is to grow the company. A mature company may have very little volatility in the price of the stock. These companies will be more inclined to return some of their profits back to their investors in the way of dividends.
Let's say I do not need to use my investments until my retirement age, 30 to 40 years from now. If I reinvest my dividends, wouldn't that be a great investment plan?
Rick, you make the most important point. Your time horizon is a major factor in what kind of investments you should consider, and why you might not want to rule out growth stocks. Let's look at the characteristics of both. Growth stocks tend to 1. Pay little to no dividends. 2. Grow at a rate of 10 to 50% per year. 3. Have major price volatility and 4. Tend to have small market capitalization. Let's compare that to dividend income stocks. Income stocks tend to 1. Pay dividends in the rate of 3 to 10%. 2. Grow at a 10% or less rate per year. 3. Have very low price volatility and 4. Tend to have large capitalization. An example of a small cap growth stock would be Square. This 11-year-old company does not pay a dividend. In the year 2020, the stock price went from around $63 per share to around $218 per share. $1,000 invested in January would be worth $3,460. Let's compare that to IBM. This stock price spent most of the year between $110 and $130. There was not much volatility. But this company is more than 110 years old. It pays a 5% dividend of $6.52 per share per year. A $1,000 investment would pay less than $50 per year in dividends. It will take many years to catch up to the gains from a good growth stock.
Wow! Square tripled in price in 2020. That's insane. I wish I had money in that company.
You have heard this before. Past performance is no indication of future results. But Rick, can you see the potential for a growth stock to aggressively increase your pool of capital assets?
I do. I really get it. Okay then. Should I invest in growth stocks?
Let's play with your time horizon. If you had bought Square in January of 2020, then sold it in December, then purchased IBM in December of 2020, you would be receiving over 3 times the amount of dividend income in all future years. Rick, do you see a problem?
I think so. In January, there was no way I would know how much Square would go up in value. And once it went up that much, I doubt I would want to sell it.
Exactly. Not even the best crystal ball will give you perfect information to pick a solid portfolio. That's why it's best to allocate your investments.
Yes. I understand. Split the funds between growth and income. So how much should I allocate?
It is always best to engage a professional certified financial planner, in order to help with the best allocation for your personal goals and life situation. However, for the do-it-yourselfer, a simple formula would be 70-30-50. Below the age of 50, you should allocate 70% of your portfolio to growth stocks, and 30% to income stocks. After the age of 50, you should allocate 70% of your portfolio to income stocks and 30% to growth stocks. This is based on risk tolerance and time horizon. The younger you are, the more time you have for a risky investment to recover. The older you are, the closer you are to needing to use your investments, in order to maintain the quality of life to which you have grown accustomed. Regular steady income is a priority, and your desire for more risky investing declines. As you already suggested, Rick, in either case, you can set up automatic dividend reinvestment, with most good income funds. You can reinvest dividends all the way up until you are ready to retire.
And since I want to do that with a Roth IRA, all of it will grow tax-free until I retire and use the funds.
Rick, I think you are onto something good.
Actually, Gabe, you just put me onto something good. I will study some growth and income funds on Morningstar. I want to be sure to pick a fund that has a good history. Thank you, Gabe, for going over this with me. I like your 70-30-50 rule.
You're welcome, Rick. It's an odd but easy suggestion to remember. Let me reiterate, I am not a financial advisor, and do not own any shares of stocks that may have been used as examples in this video. All examples are hypothetical and are for illustrative purposes. Please use this information for educational purposes. Consult your tax professional, investment advisor, or attorney for further guidance in your specific situation. Acorns is an easy way to start investing. Please use the link in the description section to get off to an easy-to-manage start on your path to capital asset wealth investing. Although they are not a sponsor, this channel does receive support when you use the link to open an account. Please leave any questions in the comments section below. Let me know if there is a subject you would like to see a video on in the coming weeks. Please like and subscribe with a click to the thumbs up below. Have a great week. See you next time with more tips for your YouTube business. Cheers.